Hello, YouTube. This is Elisha here, and welcome back to our channel, The Value Investor, where we are going to make a deep dive into the principles of value investing. Today, we are exploring one of the most crucial concepts in this discipline, which is the margin of safety. If you're serious about protecting your investments and enhancing your returns, then stick around. Right, so margin of safety. We are going to dive right in by talking about what the margin of safety is, how to actually calculate this margin of safety, and I'll use a couple of examples from legendary investors, and then we'll look at the role of margin of safety during market downturns and practical tips for implementing a margin of safety in your portfolio. Right, so what is the margin of safety? The margin of safety is actually a core principle in value investing. It was introduced by Benjamin Graham, who is one of the you know, investing legends who actually influenced Warren Buffett. It's all about buying securities at a significant discount to their intrinsic value. This cushion then helps protect against errors in analysis or market downturns. So it doesn't matter, even if your stock or investment or stock pick is actually trading at a discount to its intrinsic value, it can still go down during market downturns. But the proportion at which stocks go down will actually depend on whether they were undervalued in the first place. So if you look at most of the bear markets that happen, you look at the stocks that are already undervalued when that bear market started, you'll actually find that most of these undervalued stocks will not go down as much as their counterparts. So this is the cushion that we are actually referring to. So uh, the margin of safety is a core principle, and it's actually you're actually buying securities at a discount to their intrinsic value. So the purpose is to protect against, obviously, if you make an error, and also if there's a market downturn. So some of these errors can include, you have to estimate things like value, the intrinsic value, and most intelligent investors will use the discounted cash flow method, which I'll get into later on. But you see that in making these assumptions, people can actually have three scenarios. So these three scenarios are the best case scenario, the base case scenario, and the worst case. So if you make an estimate which is close to the best case, or which is quite over the mean of other people, of other investors, you might actually see that even if you put a significant margin of safety, you are still trading, you are still buying that stock at a very high price compared to if you had put a worst case scenario. So we'll get into that later on. So Buffett also said in his foreword in The Intelligent Investor, if you follow the behavioral and business principles that Graham advocates, and if you pay special attention to the invaluable advice in chapter 8 and 20, you will not get a poor result from your investments. In chapter 8, he was talking about Mr. Market and the market fluctuations that happen. And then chapter 20, obviously, is the margin of safety. So those are the two important factors. So the margin of safety is a core principle in value investing, and it's basically the intrinsic value of any business is determined by cash inflows and outflows discounted at an appropriate interest rate, and that can be expected to occur during the remaining life of the business. So this is actually the definition of the intrinsic value of the business. So the intrinsic value is determined by the cash flows um, that have been discounted at an appropriate interest rate that can be expected to occur during the remaining life of the business. So Warren Buffett actually says it's the cash flows of the business till judgment day. So calculating the margin of safety, it's a very easy process. What you're doing is after you estimate the intrinsic value of the stock, using discounted cash flow or the dividend stage model. Uh, if you get that value, so if that value is $100, and you are able to buy it for $70, then your margin of safety is 30%. And this is what people like Benjamin Graham often suggest, that you should have a margin of safety that is about 30%. So the investing legends worked with that 30%. And also remember that Warren Buffett has a nuanced approach to this rule. So he says it's better to buy great companies at reasonable prices than fair companies at great prices. So for all the approaches, you will need to know the intrinsic value of a stock, and price is what you pay and a value is what you get. So if you've got a great company, you might choose to buy it at fair value and not actually apply this margin of safety, because most of these great companies are always trading at very high PEs, which means that they are actually trading above their intrinsic value. But if it's a great company and you've done your research, you can actually buy that at reasonable prices and still make money. So, let's look at a couple of examples. So, Warren Buffett began purchasing Coca-Cola shares in 1988, and this is one of the, Warren Buffett says he made a few investments that really moved the needle, which means he made one every 5 years if you look at his investing career. So, at the time, the stock price was depressed, trading at between 35 to 45 following the market crash of 87. According to the DCF valuation, assuming an annual free cash flow of 20% for the first 10 years, followed by no growth for the subsequent 5 years, using this method and a discount rate of 8.65, the intrinsic value per share was approximately 85. So given that Coca-Cola shares traded between 35 and 45, Buffett's purchase price represented a significant discount to this estimated intrinsic value, providing a margin of safety of about 48%. And Coca-Cola was one of those investments that really, really pushed the needle for Berkshire Hathaway. So if you look at Benjamin Graham's philosophy, the margin of safety is always dependent on the price paid. It ensures a cushion against risk, and it's key to successful long-term investing. So personally, this is how I use the margin of safety. I have my stocks lined up, and what I'll do is I'll have my intrinsic values there from the discounted cash, free cash flow, and then I'll have the price at which I'm supposed to buy, which is 30% lower than that. And if that margin of safety is 30% below the share value, the share price, then so this is what I'll do. If the margin of safety is 30% below the actual intrinsic of value, then I'll buy, right? So then I'll have an if statement in my Excel sheet, which will tell me your margin of safety is now 30% below the current below the current price, below the current price, and then it tells me to buy. So at the moment, I, I've actually I did this quite a while back, so this is about maybe 2, 3 weeks old. At the moment, I have four stocks that are on buy, so I'll be buying those. So these 20 stocks, you see that this requires a very patient approach where you wait for the market to actually give you those opportunities. So yeah, so. So also the margin of safety kind of protects you when there's a market downturn. If you've already bought a company that's trading way, way below the intrinsic value, the market is kind of lenient with these stocks. It won't beat them down as much as it will beat other stocks down. And I've seen this in my investing. So I'd like to hear your thoughts about the margin of safety, how you use it, what percentage you use and why, and how you invest when the market is overextended. Like for example, now the market is trading above the Shiller P ratio of about 34. So drop a comment and let me know what you guys do with your investments. And this is the Value Investor signing out.